Hello, everyone. This is the pilot episode of Corporate a la Carte. Because if we are going to be eating the riches, we might as well know the nutrition facts. So, this is a financial information disclosure for none other than Amazon.com Incorporated. Now, as you can see, this is the real deal, based in Seattle. Trading symbol is this, and it has just kind of basic common stock. Let's go down and see here. Large filer, one of the largest companies. The aggregate value is this much. So this is kind of the general value of the company. So this is in the billions, I guess. Wait a minute. No, the trillions. Yes. Right, because that's million, billion, trillion. So over $1 trillion. That is huge. So that's essentially the value of the company itself. Number of shares is this much. So there are some shares that are valued at more than a penny. Let's go to the calculator and calculate that. So the average value of a piece of stock in this company is actually $2,336.71, basically. So that is a lot. So if you want to get a share, you're probably going to have to pay thousands of dollars. Let's go to table of contents. Let's go to business. So this is based on expectations, estimates, and projections. Let's find out their description. We seek to be Earth's most customer-centric company. We are guided by 4 principles: customer obsession rather than competitor focus, passion for invention, commitment to operational excellence, and long-term thinking. In each of our segments, we serve our primary customer sets consisting of consumers, sellers, developers, enterprises, and content creators. In addition, we provide services such as advertising to sellers, vendors, publishers, authors, and others through programs such as sponsored ads, display, and video advertising. So that is how their business works. They have 3 different types of operations. So just generally, and then international, and then online with web services. Serve consumers through online and physical stores. So this is, again, listing different products. And let's see here, sellers. Enable sellers to grow their business, sell their products in stores, and fulfill orders. So something of note is that Amazon is not always the seller of record. It would be, an actual seller. So that is good to know. And now let's look into the financial information. All right, here we go. The consolidated statements of cash flows. So as you can see, they've increased quite a lot over the past couple of years, especially from 2018 to 2019, and including in 2020. So business has been booming recently. Net income, as you can see, is also increased quite a lot, even higher rate from 2019 to 2020. So you can kind of see, there's more like sales rather than other ways to get money. Like they earned more cash from sales than from other methods in 2020 compared to 2019. Now there's something you might notice here is that increases in accounts or changes in accounts receivable are actually negative, while changes in accounts payable are positive. Now usually that means when there's a receivable, this is if like say there was something that's a receivable. That's could be like a sale that's made, but they're going to get money in. So you have these negative amounts because those are those are counted as sales from the net income, but they are not actually money that has actually come in. So that's good to know. Like, good to know what what money has actually come in, what money is on hand. The opposite applies to accounts payable. That's money that will be coming out but has not yet left the company. These changes, that's like essentially how we go from net income to the net cash provided by operating activities. So as you can see, yet again, there's a large increase from 2019 to 2020, perhaps even more pronounced than the other increases as like on these upper levels. Now we have investing activities. You can see that there's an even greater increase in 2020 compared to previous years. So this purchases of property and equipment, that would be purchasing warehouses, perhaps vehicles for delivery. There are a lot more of those if you look around. There's, if you go to a neighborhood, you could find multiple of those Amazon branded vans with products that are being distributed. So Amazon has been really getting into that lately. Let's see here. So this is cash used in, as you can see, because it is negative in parentheses in investing activities. So a lot of this amount, these purchases have gotten into this number, including as well as this number, this purchases of marketable securities. So that could be like purchases of different companies. So there would be some, smaller companies that Amazon buys out by, buying a lot of shares in, the majority of shares, thus owning other companies, or at least having some significant influence by having a large portion, like say 20%, 30%, maybe 40%, but not quite a majority. Now at the bottom here, near the bottom, we have net cash from financing or used in financing activities. This generally happens to be involved in debt. So it looks like lately Amazon has not been paying so much in like interest payments or principal payments in debt. So that's quite interesting, actually. So it's not like it has a lot of obligations that it has to be paying off. It's becoming more stable in that way. Now we have the statements of operations. Some may also call this an income statement. So we can have, you see here, there's the net sales, which, as I mentioned before, not really a cash-based amount. There are some sales that involve, amounts that are meant to come in, accounts receivable. So from here, we can see that there are more and more sales throughout the years. Looks like it's even increasing more and more. So, the business is definitely booming. Perhaps even like a monopoly, one could say. And note that all of these are in millions of dollars. So these are billions and billions, hundreds of billions even. Now, looking down here, there's the cost of sales, which is kind of a general, kind of like a sum of things. So maybe we'll find like a kind of a breakdown of that, but usually these numbers include amounts that were paid out in wages or salaries, perhaps perhaps bonuses as well as like any materials used in production of assets. So, but I'd say generally this would be the wages amount. So we can compare like sales and wages let's say, or cost of sales here, and kind of see how it breaks down. So in 2018, the cost of sales divided by the total sales is actually increased over time, and not by a great deal, but marginally. So this could be, say, some locations having higher wages, perhaps maybe not Bessemer, Alabama, but other locations might have had unions or perhaps some other kind of bargaining going on. Perhaps the warehouses have decided to just increase wages a little bit just because of outside pressure. There's also the kind of pressure to raise the minimum wage in some locations. I have heard that Amazon was planning on increasing its minimum wage to $15 an hour, but that might be a gradual process. Considering that the cost of sales is increased kind of proportionally, but a little bit more than net sales, we can kind of assume that it's been more of a gradual process, given that it's kind of started in these previous years, like 2019 or maybe 2018. Now here's something even more interesting. So we have operating income, which is kind of a net amount. Some might call this gross margin, one could say, because it doesn't quite include these other amounts, like interest or income taxes. So some could call it earnings before income or earnings before interest and taxes. So this is a very big indicator because interest can change, taxes can change, but the company is in control of these. So let's see. Let's divide these, or rather, compare these to operating expenses and see how those change over time as well. Okay, so we have divided the operating. Let me see here. Operating income, which is kind of this net amount, compared it to cost of sales. As you can see, this ratio has actually gone up over time. So more money is going into just as kind of as profits rather than going into wages. So it's like more like kind of a shift more towards profits rather than wages or salaries or other inputs that would go into this cost of sales. That's quite quite interesting. That's kind of like a conclusion you can have from this, which is quite interesting, as there's just this amount that could be going to employees but is not. So it would be interesting to see the wages, like the breakdown here, but it doesn't really show that, unfortunately. And now we have the consolidated balance sheets. Again, it's in millions except for per share data. So that would be like divided by the number of shares. I don't quite remember the number of shares out there. I think it was like 500,000. So that is that. So as you can see, it's based on 2 years instead of 3 years. It's just kind of a common occurrence that businesses do just to compare 2 years, but it does help to compare them. So let's see here. If you look down here, you can see that there's actually a pretty large increases in lease liabilities and debt. So that would apply to financing activities, which I didn't really touch on, but it just kind of ties into the the amounts that are paid out for interest and principal. So in order to borrow, you borrow money and then you pay it back. So these are like amounts that would have to eventually be paid back. So they've really been investing a lot. This kind of ties into the purchases of assets. Maybe the company has taken out some long-term loans, for example, in order to purchase all those assets. Now we can go to item 6, actually, which I've actually decided to look up the basic earnings per share, and let's see how that's changed over time. So at first it was in millions, so except per share data. So each share was essentially, like based on this, was worth $5, and then it was $6, then $20. So there was a major increase from 2017 to 2018. And then yet another major increase from 2019 to 2020. So that's quite interesting. Let's see the number of shares, by the way. So we can see the calculation of diluted shares, and we can see the number of shares used in computation of that basic earnings per share. And you can see they've kind of been quite consistent. So essentially in this 2019 to 2020 period, the value has gone up, but the number of shares has been staying the same. So it's not like, say, there's way fewer and thus they're worth more, but rather that there's just so much, so much income, so much retained earnings that the value of the shares has increased. So that's definitely something worth noting. So, for example, if there would be more money going to wages, to cost of sales, there would be much less of that, earnings per share. Let's see here. So these numbers would be much more similar, and possibly even more similar to this earlier number. So that's definitely something to keep in mind. And I think that would be a good conclusion to this episode. Kind of just a rundown. And, tell me what you think about the series. I could kind of iron it out. This is kind of something I've decided to do because not too many people really look into this kind of information. So I felt like it would be good to give it a little bit of flair, kind of an interesting approach to it. So let me know what you think.